And with that, welcome everybody to Boroughs and Burbs, episode 83 on the banking crisis, where we all want to know, are we waiting for this to all blow over? Will it blow over? This is our show on the future of lending. And I have five experts on the show today. I've got Bill Carmack from Quantic Bank, and he is a suggestion of Roberto. Roberto said, you've got to get Bill Carmack on the show. All the loans in New York City seem to go to Bill Carmack. No matter who you call, all roads lead to Bill. And so I said, all right, we're going to get Bill on the show. I asked Rick Muskus to join us. Rick Muskus, I knew back in the days when he was at Greenwich Bank, and I needed commercial lending for my office building. Then he was at Patriot Bank, and we worked on foreclosures together. And now Rick is at First County Bank and getting it done. So I'm going to have to catch up in front of all of you with Rick Muskus. Bill Raphael. Bill was really interesting yesterday. You had a lot to say about changes. I think, Bill Raphael, you've been most recently in Harlem, and now you're also working in Connecticut. So you've got a foot in each of the states. And you suggested I talk to Justin Carmichael of Neat Loans, because he's got one of the best electronic platforms in banking. And certainly no discussion on banking would be complete without a conversation on the impact of electronic banking and digital banks. So with that, welcome all of you. And I'm going to start with Rick Muskus. And I'm going to ask you for the broad view, because I know you've been running community banks for the last 20, 30 years, Greenwich, Patriot, First County. What the heck happened to community banking? I blinked and suddenly we went in New Canaan from an ordinance not allowing any more banks into town to where did all the banks go? So, Rick, help me out here. What happened to community banking?
Well, I'd first say, first of all, I don't run First County Bank. I am integral to their lending platform. I'm a chief lending officer and handling all the lending activities, commercial, residential, consumer. So to answer your question, we don't have enough time today for that. But when we're talking, I could talk from a perspective of a community bank. And community banks are not what we've been, at least the challenges you refer to a crisis, that has not been really community bank centric. Fairfield County, Connecticut is a unique animal in this country, very competitive. I think that there's just a heightened level of awareness in terms of how we build our balance sheets these days, how we manage our credit risk these days. We all, and I'm sure Justin and others will talk about the real interest rate environment in the consumer space. But I think just speaking from a community bank perspective, First County is a 172-year-old mutual. It'll be here 172 years from now. We stick to our knitting. We serve our community. Lower Fairfield County in particular is where we exist. That commitment will never change. So that customer base, the loyalty of that customer base is much different again than, say, the Silicon Valley issue we saw recently, where it's not a community bank. We could talk ad nauseam about the issues that happened there, but my point is, one is not like the other. We're talking apples and oranges, and our community banks are healthy in the state of Connecticut. We're a very close-knit group of institutions. We're all looking out for one another, and that begins and ends with our customer base. So that's a real broad perspective of what our I'd say long view is. These aren't public institutions, right? We're independent. We don't have shareholders. We certainly, we're always looking around the corner from a safety and soundness perspective. And I'm sure we'll get into some conversation today about the availability of credit and the potential tightening that may be around the corner as well. But it's business as usual from our perspective.
All right. Does anybody else want to help me out with a change in banking that caused us to go from 18,000 banks to 4,000 banks in America? I mean, the perception in my mind was that I used to have a choice of Darien Bank, New Canaan Bank, Webster Bank was here. They pulled out. We had a Bankwell. They decided to not lend mortgages. So I have a perception that there is less choice from community banks in luxury markets than there used to be. And I get the perception that maybe electronic platforms have risen to fill some of that void. So Justin, is that a correct assumption on my part that electronic is coming in and filling some of that void?
So I would say yes, that is a solid assumption. I can't really speak to the number of community banks and where they've gone or why they've gone by the wayside, but definitely the correspondent model is gaining momentum in the mortgage lending business. The technology, the user wants that experience. They want the transparency and they want the trust. And quite frankly, they want the options. A bank like ours, we're a correspondent bank. We have 16 or 17 different banks that we lend on behalf of. So we have options. So there's never a single lending source concern. We can help shop the market for these people, whether it's a community bank or a national bank. We can help them navigate through the complexities of their credit profile and find the best mortgage program for them. And that service level, generally speaking, is really gaining a lot of momentum in our industry and in our space. I mean, all the top 3 mortgage lenders in the United States, or 3 of the top 5, are correspondent banks because people want that option. They want that flexibility. Our platform happens to be the only end-to-end technology platform built in the last 10 years that is transparent. It's condensing the processing time of these mortgages and making the customer journey a lot easier. But I do think that home buyers are going towards that model on their own. And quite frankly, and Chris can probably say this too, a lot of the real estate agents and financial planners that are out there are also sort of guiding their clients to that space because they know that they want good service, they want good options, and they want security of multiple lenders so they can be safe with their mortgage.
Well, how about as a quick question, is there a differentiation between the luxury market and the jumbo or the super prime versus the more average American type mortgage? I mean, at what point does the electronics start becoming not as cookie cutter or able to be serviced versus the local banks going, no, I get this piece of property and I can make a loan happen that others may not? Right.
So that's a great question. The reason why we built our technology, going back to the onset of our company, was because if you look at a credit card or a car loan or a student loan, you can get those in days and hours. And we couldn't figure out why mortgage is 45 to 50 days. So the technology that we've created is built to handle the complex buyer, right? As Rick said, Fairfield County, Connecticut's its own beast, right? And we want to be able to understand the complexities. Most people that are buying a $4 or $5 million home, aren't hammering out that income on a W-2, right? They've got multiple K-1s or Schedule E businesses. So the technology platform that we've built allows us to interpret that income as the borrower is filling out the application. The reason why we did that is because we wanted to be able to serve the simple W-2, take home a paycheck, first-time home buyer, and the complex, investor or, high-end buyer, so we can cover that whole range. So I think we're seeing all of those customers sort of migrating this way. And keep in mind that there is no real pure technology play. You can't have that. Somebody who's buying a $1.5 million home in Fairfield County, Connecticut, or anywhere in the world is most likely not going to dial into a call center. They're going to want to speak to somebody that understands the complexities. I talk to every client. We make sure we know what they're doing. Then we introduce them to the technology. So it's sort of a hybrid model. You have to handhold because you want the customer to know you're there, but you have the technology backing of your platform to make sure it's seamless.
Can I ask you guys a question? And sorry, I'm late. I drove to DC, and the only thing I really want to do right now is go to the bathroom, but that's okay. I have a question with regards to just, we're talking about it like and Scott introduced it to a higher level of like a luxury buyer. I had a buyer and I spoke to Bill about him and a bunch of other people. And he was a guy buying a very, very expensive home. And he was looking for a loan of 10 to 15 million. And no one would really touch it because like our limit's 5 million. But you guys also, I'm assuming, also had loan on multifamily, which are like 15, 20, $30 million loans. Where is that gap bridged where just for this guy, like 5 million was the limit? And is there going to be, and this was last fall that we started this process and we were before any of the regional banks situations happened. Like, where is the gap for that buyer who wants to buy something that's 30, 40, $50 million? They want to borrow 10, 20. Like, who's lending to that? Are either of you guys doing that?
We're not, I don't have a lender in our sort of portfolio right now that will go that high. Now, having said that, we have a nice mix of sort of conventional banks, Fannie, Freddie regulated, and we have a couple of portfolio local banks that lend their own assets, are going to make a little bit more outside the box credit decisions. In that case, that's something that I would take to them. But even in that instance, we're going to be capped out at that $4, $5, $6 million loan limit in the traditional lending space right now for residential anyway.
But so if I had handfuls of these buyers, which God bless if I had, but where's the first stop for a place like that? Because I must have made 40, 50 phone calls and it was a stop sign at almost every stop.
Well,
Roberto,
my bank,
I'm sorry,
we go to 3, excuse me. We go to about 3 million, and that's as high as we'll go. Some lenders, like Justin said, 5 million is another cap. And then there's very, very few that will go over that. Those would be all, private portfolio lenders. They could be a bank, they could be a mortgage company, they could be, hard money guy. So
someone who's buying a multifamily property that's say even 40 or $50 million and it's 40 units or whatever it is, who's lending them that money? Is it a regional source?
Well, that becomes a commercial loan. If you're over 4 units, it no longer is residential. It moves over to the commercial space. So that's a whole different loan.
Right,
I gotta say that what Roberto's getting at, and I see Rick is ready to go with the answer on this. Roberto and I are finding that the bank rules, Fannie, Freddie, and all that, fits so few of our customers in the luxury market right now. We're like, what are you talking about? $400,000. I can't buy anything within a 20-mile radius of where I'm sitting within guidelines. So increasingly, bankers come to brokers like me, like Roberto, and they say, I have the best rates. And brokers like us say, I don't care if you have rates. I just want to know, can you get the deal done? Because all of my clients seem to have some weirdness attached to them. That's how I found Rick Muskus in the old days at Greenwich Bank. He's like, you have weirdness. I handle weirdness. I can make loans. I am a portfolio lender. I am your man. And, and once he did one deal for me, I was like, oh, he can handle anything. Rick, do you still handle everything?
Everything is this wide, so it's we do what we do, but I think the point there is portfolio lenders have a lot of latitude to decide what's how they define risk and mitigants. So weird is weird, right? Portfolio lenders typically try and figure it out if there's some factors that coincide with the level of risk. Now, when we're talking about, again, back to, large apartment projects, for instance, anything over 4 family, again, is a commercial loan. There are a lot of lenders in that space. We do an awful lot of that multifamily lending in our market, Westchester, Fairfield County in particular. But there are a lot of lenders we deal with regionally, a lot of name brands that, that's their business. So, I think it's a less of a challenge to find a lender that is, it may be interested in a 30 or 40 unit apartment building stabilized in a good market, properly margined, than it is to find a $15 million home loan for somebody, which in my space, recognizing there's some very talented experts on this call here. In my space, that's always been a kind of private banking approach to a loan, and you know, it's just not prevalent these days. I think it is difficult. We
Yeah,
cap out at around 2.5 million in our resi portfolio.
Rick, I agree. I think when you get into that space, Roberto, like it's either a cash deal or it's definitely a private banking, a pledged asset type of deal with wherever they have their money parked. They're going to lend against the borrower's own assets, and that's, you know, that falls outside obviously the normal mortgage or banking space. Once you get up into that level, it's going to be more private.
Okay.
We had a situation with a colleague of John's about a year ago, which the buyer was purchasing a $22 or $23 million residential property with a horse stable and some other amenities that were above and beyond what would be commonplace. We were able to get them 50% financing based on the fact it was not going to be their primary residence, as we have some investor and portfolio lenders that have an appetite for this high-end outside of the box business. The gentleman was not rate sensitive. He was not particularly term sensitive as much as he wanted to get his hands on the property with as little out of pocket as possible and a way out within a 2 or 3 year window without getting beat up too bad. It's a rarity, but we do have a niche for that. And often in some of these areas in the Northeast, there are some unique homes that, as John said, sadly, the conventional Fannie Freddie financing fits very few of our day-to-day clients. It's just not particularly, it's just not particularly fitting for what the property values and the ways of life of many in our part of the world.
Now, Billy, yesterday you talked about the declining margins for making these loans. Do you want to tell the panel a little bit about what you told me about what appeared to be an unsustainable model, that the Fed raising rates, banks making these loans, making them at less of a margin than they're used to, less of a margin than they're comfortable with? What did you mean by that?
Thank you. You know, really what I was talking about was currently right now, you have a lot of banks that are responding to what's been going on by going out there and trying to maintain deposits, right? Very, very important. And so by doing so, they're going to have to attract those depositors to stay at the bank. And what they're doing is they're offering, you know, much higher rates on things like CDs. And shorter term instruments, and at a much greater level than they have been in the past. And so if you look at what banks need, and Rick can speak more to this, but if you look at what banks need, you know, to make money, and, you know, you can just say, you know, let's just say the rule of thumb is, you know, 3%, you know, over, you know, your cost of funds as an example. Well, that would put you, if you're putting out currently, you know, 4 3/4, let's say, and that's your cost of funds, could be as high as 5 if you're taking some of the money that's been thrown out to increase liquidity in the banking system right now. So you're talking about, you know, rates at 7 3/4, 8%. The bottom line is that's not where rates are. So, you know, so banks are basically not going to be lending, and, you know, you're seeing this, I'm seeing this increasingly. So, but I think really what it comes back to is what Rick was saying. I mean, right now there's going to be an adjustment in how everybody perceives risk, the health of their balance sheet. And, but I think there are going to be, I mean, listen, lending is going to continue. I just saw something this morning saying that, you know, I think we're going to take an 18% hit in originations, but the number's still like 2.6 trillion in originations. I mean, that's still just a lot of lending out there. So I don't think, to Rick's point earlier, I mean, we have a different animal here in Fairfield County. And I think that, you know, business as usual, but certainly there is going to be increased scrutiny. There's going to be, I think the banks are really going to be looking at their lending activities, making sure that, I mean, they got to be profitable. So really, that's what I was speaking to when we had that conversation yesterday, is that some banks with their cost of funds, they really can't price to be competitive and still make money.
And I think, Bill, to that point, you know, we've had I can't tell you how many phone calls from clients. There's a huge buyer demand out there. That's what people don't understand. There are a tremendous amount of home buyers that want to buy houses right now. And if you look at what's been going on in the current market regarding the banks, and you look at some of the market indices, that generally show downward trends in interest rates, right? The savvy buyers looking at these market indices, calling and saying, have rates gone down? Have rates gone down? I'm looking at the 10-year yield, have rates gone down? And I'm saying no, because banks aren't reacting the way they normally do in the current market. They're sort of holding the line until they get through this and figure out what's going on and where does that security land.
It was
It's
only,
been
I guess, 1 or 2 quarters ago, and I don't mean to interrupt, Rick, you keep going, but it was only a quarter or two ago that JP Morgan and some of the other big banks were reporting record profits. And so it's a little surprising to hear Billy say that they're now getting squeezed, and if so, for how long? But go ahead, Rick.
Well, I mean, I was going to just make the simple point that, portfolio lenders, everyone has a different cost of fund structure. So, your desire or your ability to lend is based on that. It's certainly based on your liquidity. So, when banks are out in the market looking to either replace amortization or payoffs or grow, for instance, I think in the short run, it's going to look a lot different because of all these real fluctuations in interest rates have caused a little bit of chaos. And for the past, as Billy pointed out, for the past year or so, banks are out there trying to drive deposits, and as a result, having to increase rates accordingly for their time deposits and other types of deposit products. And it's driven the cost of funds up. That's going to take a while to burn down. So when we're looking at pricing commercial loans today, we do have a bogey that we test against, which is FHLB, but that moves around like every 5 minutes. Our time deposits don't. So it's like slowing down a battleship here, where we're forward thinking maybe 30, 60, 90 days out, but rates don't catch up that quickly. So I think First County Bank in particular, we're asset quality is the name of the game to us. We will pass on deals even at 7 or 8% rates that may be really beneficial and accretive for us. But there's where I see the credit slow down, is when the banks, portfolio lenders in particular, become a lot more choosy about what goes into their portfolio until we get through the unknown, which again, recession or a slight recession, there's still a variable out there for 2023 into 2024.
Yeah, I think Rick's right on the money. We're Quantic is it's a small federally chartered savings bank, right? And we lend on our portfolio. Our source is depositors, so we're paying them CDs at 4.5, and we're non-QM, so we lend in the 8s. So that's pretty good formula. And sometimes it may not be that competitive because it is a bit of a race right now to the bottom, in my opinion, on price. And we're holding our price because for that exact reason, we don't know where it's going to land, right? This could be a dead cat bounce in rates, and we might be right back up there again. So, we're holding it on the portfolio. We're not selling it to anyone. And, we could be looking really good if rates, keep going down. We have all these high interest rates that someone will buy eventually, or it goes the other way, right? We don't know yet. And if you got a bag of loans at 7.5 and they're high risk, there may not be a buyer out there for that, or at least a profitable, someone that's willing to pay you some YSP on that portfolio. So,
how are your volumes from, say, 6 months ago?
what volume?
Yeah.
Oh, off 70%,
Wow.
maybe more.
And what did it look like, say, just like 2019 pre-COVID? From that time period?
Well, I was working for a different bank at the time, and it was rough because people were really nervous. There were people just when COVID hit, and I'm sure everyone else that was in the game then knew. I mean, there was commitments that were not honored at closing tables, and It was pretty scary. You know, it was a drastic change, but it was short, right? It came back rather
Yeah.
quickly, you know, once the liquidity loosened up. So that was a weird one. That was like not unlike all the other ones I've been through. That was like not good, but very sudden, but kind of bounced back pretty quickly, you know?
So Rick just used the words of getting through this period of unknown. What does that mean? Because I thought that the Fed had already signaled how much they were going to raise interest rates and why, and that we're ending the end of that cycle. The people who are talking about recession talk about a short and shallow one. So what does that mean, the unknown, from a banker's point of view? How are you evaluating risk? I thought what Bill Carmack just said was very interesting about holding a bag of 7.5% loans and risk that those rates might go down. What does that mean, the unknown? What's worrying bankers right now? Are you worried that the Fed's going to come in and raise rates substantially? Are you worried that the Fed's going to start re-regulating based on the failure of a couple of banks? What are you worried about?
Well, I'm not an economist, but I can tell you that we believe, or I'll speak for myself, I believe we'll see another slight increase in rates. I mean, everybody's talking a quarter point, and then we'll flatten out. But I can't guarantee that. Nobody can. The unknown. To my residential lending friends on this call, I saw a 70 basis point drop in the 525 FHLB amortizing in 7 days. I mean, there's been just a huge rate drop. I know NEAT is pricing 30 years, I think at 5.25 now. It was like 6 a week ago. It's that type of unknown. If you asked me a week ago what rates were going to be, I'd say they'd be unchanged. So we can only control what we see. I think, again, as a portfolio lender, community bank, community centric, who we do business with, knowing the properties, being very, very customer centric, that is a big component of how we manage our credit risk. We're not a nationwide lender. There's, Chris, with cross country, you're one of the largest lenders around. I mean, number 4 or 5 in the country, I think. You touch every market. I don't have a lot of insight into maybe what's going on in Florida or California, but what I do know, John, to answer your question, is we have limited predictability in interest rates on a trailing basis. A year ago, I never would have thought rates would have increased so quickly, but here we are. But hopefully, I think we all agree to this. Hopefully, we're kind of managing the end of the increase cycle, and then we have to deal with our portfolios and how we really manage our balance sheets. Probably for the next couple of years.
And I do think it's going to play out in that length of time, Rick, because as all of you gentlemen know, the rate hikes are often aggressive. The decline is much more gradual. So, we're not going to see a return to where we were anytime soon. A month ago, the rates were in the 7s again, mid-February. They've come down in the range of the low to mid-5s, depending on the day, on a conventional 30-year fix. But the truth of the matter is, I think we're going to be in this level for at least the better part of the year. So I don't think there's going to be a significant reduction in rates anytime real soon, just a gradual drop.
Yeah, and I think that's interesting. I agree with that 100%, right? And what the interesting part of all this discussion that we're having right now is it doesn't seem like the home buyer cares. The demand has gone through the roof literally since this whole banking meltdown, and everybody's freaking out on MSNBC and wherever you turn, it's doom and gloom. Everybody wants to buy a house. I mean, the buyer demand right now, I call it a mini COVID, right? During COVID, there were 500 people fighting over 150 houses, and now there's 50 people fighting over 12 houses. It's the same supply and demand. It's just on a smaller scale. But the consumer, when we went from 3% to 7% in 90 days, that was a quick slap in the face. And I think everybody's now gotten to the point where like, this is where we're going to land for a while, and that's okay. It's not really bad. And they're out there. They want to buy houses. So whatever happens long run, the consumer, the home buyer is sticking it out and not afraid to get out there and try to make this happen.
It's really funny because I experienced the exact same thing. All of my last year, it was a jolt, and everybody just kind of took their breath. Sellers and buyers both. Sellers not putting their properties on the market because they didn't want to sell into that environment. But I've had buyers over the last couple of weeks, just with all this banking stuff that's been happening, and they're just like, so what's going on? And like, so what's the rate today? And okay, let's make the offer. You know, they really have not even been affected by it at all.
No, they got scared, and then they're like, okay, here. I mean, nobody, I don't think anybody in this room or in this planet thought that 2.5% 30-year fixed rates were going to stick around for a long time, right? So it's not uncommon that we're riding things out in the mid-5s, low-6 space. And I think the consumers sort of come to grips with that's what we're going to be for a while.
I would agree. The pandemic rates were the anomaly. Often, and I'm sure you've all experienced it, when the client asks what the rate is, really to have any comprehension what that translates to dollars and cents to begin with. And unless it's a savvy buyer, and if it's more likely a first-time home buyer or someone really just moving into a modest home for an improvement of their quality of life or family, they're focusing on a monthly payment. After the hysteria of the rates have skyrocketed is digested and they realize what it looks like dollars and cents, people gradually start to get their brain wrapped around it and become much more comfortable with it.
It's far more difficult on the buyers who were looking a year ago and they're still looking now, as opposed to someone entering the marketplace now. Because now is just a reality to before they're looking at things they can no longer afford.
Yeah. And the consumer also, the flip side of this with this banking thing is there's this, sort of PTSD of the 2008 market where, everyone's like, oh my God, here we go again. And I'm never going to get a mortgage and I don't make enough money and the banks aren't lending and I can't qualify for it. And then they get on and they go through our platform and they see in real time, they're like, oh, I'm approved, right? So it's the fear that banks are tightening up so much that window that you have to fit through in order to get approved for a mortgage is almost non-existent. And quite frankly, that's not true. There hasn't been, normally when things like this happen, banks will put what they call overlays on top of their guidelines. Like, these are our lending guidelines, but now we're going to make them a little bit more stringent. And we haven't seen that yet. So that piece of it is not tightening up. And from what we've seen, knock on wood, there hasn't been much change in the lending industry on our side.
But is it coming? I think, yeah, that's exactly what I wanted to hit on. I think there is this panic. There is this feeling among my customers that it's coming, that you're going to add those overlays, that credit is tightening.
Well, I mean, Rick, you can probably speak to this if you guys have had internal discussions, but my quick answer to that is, unless it gets significantly worse, my personal view, unless it gets significantly worse than where we are today, even if there's overlays placed, it's still not going to be wickedly restrictive. I think a lot worse has to happen for us to get to a point where the lending space in residential financing is going to become really, really, really difficult to come by.
We just put a 5% overlay on LTV for declining markets.
Yep.
Not a problem in New York. Pretty much the whole East Coast is fine. So I get the deal in just last week, about a week after the overlay. The appraiser marks it as declining market. It was Arizona. Nevada, sorry, Las Vegas. So they marked the whole city of Las Vegas as a declining market. And the broker was like, oh, declining market. You mean this block? No, Nevada, Las Vegas is a declining market, according to that appraiser. I'm waiting. I have another one coming in. I want to see what the guy marks it as. But that spiked the deal because now the borrower's got to come up with 5% more. So it's a way the bank protects itself, obviously, against having negative equity. But, all the loans we do are all big down payments, because we're taking a higher risk. We don't do Fannie or Freddie. So it's 20% down, 25% down, 30% down, right? That's what we do. So in this case, it's a stretch in the beginning to start, right, guys? I mean, the guys that do some Fannie and Freddie, 20% is a lot down for most people.
Mhm.
And 30 is really tough. And this, I think the deal's still coming together, but it was the first, I haven't seen declining market overlay in, I don't know how many years. 15?
Yeah, that's true. I haven't seen that in a while.
Yeah, 15 years. So it was like, oh my God, that thing
Yeah.
is back.
Just another thing to deal with.
It's like a salesman's worst nightmare. Oh, 5% in declining market.
Well, let me raise the level of difficulty for a minute. There's a whole lot of obsolete real estate out there. And when somebody buys obsolete real estate, you need to renovate it. And if you renovate it, I mean, if you look toward like New York City, a finished apartment has a huge premium over an unfinished one that needs a whole lot of work. Because again, you have the time loss of trying to do it, the headache and those things. But trying to get, can you guys talk a little bit about how can you get home equity loans or loans for construction? What's advice in order to make that happen, and how much money is out there for that, and what's the best way to go on getting renovation money?
Christopher tried to,
Yeah,
Christopher answered this when I asked this question of him yesterday. I'm like, how much can I expect to spend? And he said the prime rate's 8. And if you're lucky, you'll get somebody to go give you some discount to the prime rate as a teaser rate. And you know what, Christopher? Nobody's given me a teaser rate so far.
We're not done working on that together then. But we have a division for renovation and construction loans, and I can't speak intelligently about it like someone who's a specialist. But it tends to go in waves, and I think that wave is upon us. Forgetting about on the commercial end a minute, and the commercial loans that are going to require refinancing in the next 24 to 36 months is going to be a crisis in its own right. But that's not on, at least not on my end. That's not my day job. There is a variety of different loan programs that allow you to do the renovation work or construction within the confines of the mortgage, but they're limited to how much net cash in hand can be distributed. And those numbers don't really coincide with what's often necessary in the Northeast. So I don't know what the solution is just yet, but I suspect that's a caveat that's going to have to be sorted through, because there is so many properties that are really in need. And on a high end, forgetting about the fact that, and I'm sure John deals with clients like this constantly, that are looking to shop, and forgive me, we're all in different tax brackets, but the numbers blow my mind a bit. Somebody looking to shop in a 1.2, 1.5 range under the pretense they need $300,000-$400,000 to make the house livable. How did things, how did the everyday family get to a point that type of undertaking was required to be able to buy a home in an area where they either want to utilize a school system or not be afraid if they forgot to lock their door when they went out? So I don't know what the answer is going to be to that, but there is certainly a need for it, and I suspect it's on the horizon.
And there are construction to perm loans out there that, in the simplest of terms, they'll lend based off the projected end value of the house. So if there's a house that's just knocked down now and you have all your plans and specs, and it's going to be worth $2 million when it's done, and the bank will do that analysis. They'll look at the plans and specs and they'll comp it out against the current similar house. Now, they'll give you 80% of that. You're going to have to be into it for 20% of the original purchase. That's your skin in the game, right? So if the original house was $500,000, you're in it for 20% of that. If there's enough equity, they'll pay the rest of that financing cost and purchase cost and all that kind of stuff, right? That's very rare. To Chris's point, it's very rare that happens, because you have to buy a tear down for $700,000 and it's going to be worth $2 million when you're done, but it's going to cost you 1.8 to build it because the cost to build is so high. So it's hard to make those numbers work, but they can get pretty close. And the other problem is that it's hard to do a true one-time close, because in this market, if you see that house and it's worth its salt, a builder's going to want it and 10 other people are going to want it. So generally what happens is, if the house is manageable enough, you write a purchase money mortgage, you take it off the property or off the market, you get your plans and specs, and then you reapply for a construction loan. But it's very rare that you bridge that 100% gap between the cost you need to build and the cost you need to buy it.
The other layer of that expense is, in order to do the renovation, you got to live somewhere else.
Yeah, exactly.
So there's a whole other.
And there's no rentals.
Right. Other than that, it's easy.
Yeah, other than that. I have
So,
a question. So the bank, I mean, the government essentially loaned the regional banks like $300 billion. And everybody's talking about all the commercial properties, all the B and C buildings that have, I think you mentioned $2.6 trillion that needs to be refinanced coming up.
No,
I
what I
saw
was
her
saying
figure-
is that the new originations predicted for 2023, we're talking residential market, that's 2.5, trillion in originations. What I'm saying is down 18%, but let's put it into perspective.
Okay, because I just heard a figure that was 2.8 trillion that needs to be refinanced in the next like 2 to 3 years, which everybody's in a great place and they can pay their debt and everything. But when those things mature and that turns over, depending upon where rates are, there's going to be a lot of people who are going to be experiencing a lot of pain. Is it the government's responsibility, or are they going to be looked at to say, look, this is the other shoe to drop? You gave them 300 billion. This is 2.8 trillion. What are you going to do?
cut that out. I cut this out of the Real Deal 3 years ago.
What's it say?
It says, is it backward?
I just can't see it. It's so small.
There's
Oh, it says multifamily loan maturities will jump to 128 billion by 2025. And I cut this out in 2019. It's been sitting on my desk over here for 3 years. So you're right on. All these loans are coming due, and nothing was refinanced in the last 3 years because of COVID, right? You're not going to do a multifamily in the middle of a pandemic. So that got pushed off. So that number, all these balloon notes are coming up. There's going to, my first thought was, hey, it'd be good to get a job in the loan workout department of multifamily lender because they're going to be busy.
So what happens if the government doesn't come to the rescue, which they can't afford really, or they're going to print so much paper that it's going to, inflation is going to go through the roof, and we're fighting that to begin with. And inflation is actually easing right now, and it was primarily probably because of supply chains and energy costs and things like that, which are now starting to moderate. And the credit markets, which are pretty smart so far, they're kind of betting on the interest rates to ease, at least level off and ease, like we spoke about before. But I don't have any purview on this. I don't have any perspective, and you guys are more in this space than I am. I'm just curious what your thoughts are on that.
I think they're going to have to do a lot of loan workouts. That's what I think, especially in a multifamily. But there's huge opportunity there because sellers are going to have to sell, right, at a lower price or do a short sale. I've been in the multifamily lending space. I'm not in today, but these, when you're talking big apartments with 40 units and above, right, that's a different market. And I think that's the one that article was discussing, like these really big mortgages and that are coming due. They're 5 or 7 or 10 year balloons, arms that were set to reset, and coming due. So it's going to be very interesting, but it's going to create opportunity if you're in the market, right? Because the property is not going to disappear. It's going to trade somewhere.
But it's going to trade at such a depressed value that if you start to mark everything to market, it's going to be, Morgan Stanley posted something. I didn't read it, but someone had mentioned it. Morgan Stanley said it's going to be a bloodbath. I mean, that's just a sensational headline, but.
Well, I guess someone's going to come in and scoop them up. Your wealthy clients will come in and buy them.
Bill, I think that's you're on track for something I was thinking about and we've been looking at for a long time. That the key differences between today and say, 2008 are availability of credit as it stands today, and the fact that people that may have bought into the market, and I'm talking about home buyers, bought into the market 3, 4, 5, 7 years ago, 10 years ago, have properties that are worth substantially more today. So, it's not exactly the same formula that we faced where there were no lenders in the market and we get depressed values on real estate. Now, it's market to market. We know that there's been some stress in certain markets across the US, but focusing on Fairfield County for a moment, I don't think there's going to be a bloodbath. I think there may be pockets of stress where people were highly leveraged to begin with. There may be specific circumstances where properties deteriorated et cetera. So, I think as long as the availability of credit is there, and as Justin spelled out with his platform, there's timing is everything. If somebody can, prove for a solution well in advance of any perceived stress. I mean, there's always people that lose their jobs. There's things that happen. But I think generally speaking, I don't see it as a really big risk overall in our core market. The commercial side could be different, but we all know rental properties are at a premium. I'll speak to Greenwich, Stamford, Westport, Darien. They're major premiums. You can't build enough of them in Stamford. It doesn't seem like the absorption rates are through the roof. So in the short term, I think there's stability. I think what we're going to see are banks, really, I hate to use the word tightening credit. I think they're going to be thoughtful about risk going forward. And that could mean different things to different institutions. But, nothing, again, another plug for your community banks. They know their market. They know their borrowers. The risk is just managed a lot differently when you're talking about a micro lender in a small market. I think our market is relatively safe on a go forward basis, but there's always these things that may pop up that I think are pretty isolated.
And I think, Rick, to that, I think that's a great point. And I think that the big thing that we don't have now that we had in 2008 is we all remember that banks were lending 100% financing with no income and no asset verification. If you fogged a mirror, you got a mortgage, right? So now you've got people that had 100% leverage on a property that depreciated overnight. And banks haven't gone that way. I mean, it's really hard to find anything over 80% in the jumbo space, and it's probably been that way for the last 4 or 5 years. So there has been smart lending that's been maintained throughout the industry for years. So, there's clearly, when you go from 100% financing to 80% financing, it's called tightening, right? But that's getting back to what's normal, and that's what we should have been doing all along. And that's where the industry's sort of been hovering, which gives us a little bit of comfort on any of the tightening moving forward.
It is much different. I was at IndyMac on the last day, so I know it very well. But I think on the multifamily, we have inflated rents. So, when you're doing your calculations, your DCR calculations on the rent roll for multifamily, it should come in pretty strong, as long as there's a lender out there that's willing to do those deals, right? Because now rents are as high as ever.
Let's talk demographics for a moment. I mean, if we look at what does America look like right now? You've got 80 million baby boomers and you got 80 million millennials, my daughter's age and my mother's age. And then you got half that many, 40 million of the people like me in the middle. The baby boomers are not selling right now because they're sitting on 3% interest rates. And they don't want to downsize out of their 5,000 square foot house into a 1,500 square foot condo because it's going to cost them the same. So a lot of them are wed to their rate. So we've already said the boomers aren't selling. My cohorts, we don't matter. We're too small. You've got a lot of millennials. You got 80 million of them. Last I checked, who are 30 years old. They've got they've been working for the last couple of years. And they want to buy a house, and now they're competing with 12 other people on that $1 million house in Fairfield County. Who's going to meet their need? I hear NEAT saying we've got an electronic product for them, and they're comfortable with electronic product. These are not relationship oriented customers. We think we've got something for them. And I also hear Rick saying we know the properties, and we are relationship sellers, and we know this county better than any of these rocket mortgages who are coming out with electronic platforms. And I've also heard that it's the private banks who are going to pick off all of Scott Hobbs' $30 million cohorts. So the private bankers are going to pick the super wealthy. So who's going to be there for these millennials as they come out from New York and buy their first house?
Well, I think the millennials, again, technology, right? All mortgage companies have technology. I mean, everybody's got online applications now. Everybody's has their platforms and whatever they call it. And, you know, millennials don't, the younger they get, the less they like to talk to people, right? They like to talk to phones. They want to sort of be handheld, but they don't want to be handheld, right? And that goes back to the root, and I don't want to self-promote, but it goes back to the root for why we built this technology platform with, you know, they don't like to wait. So the technology is there on our platform that they can get a 24-hour or 48-hour full credit approval, cash offer, close in 20 days, right? Because the attention span is focused on 100 other things, right? So
what do you mean underwriting takes a week? Nothing
I know.
takes a
How
week
dare
anymore.
you? Right. Yeah. What
I
are
get
you
Amazon
thinking?
quicker than that.
Yeah. So, you know, I mean, but it's true. Like that industry, our industry has never been condensed before. And that speaks to what the future needs of the home buyer are going to need. They're going to need that solution. It's transparent. They understand what they're doing. They control the journey. And they have the options that they need. And you know, Chris's bank is the same way, right? It's correspondent banking. They can come in and they can see what the options are. They know that they can work with one person to get their financing needs met. And, you know, it's not a big, scary bank that, you know, it's 1% of their, 1% of their business is mortgage lending and they don't want to fix it. It's clunky and it's broken and there are better places to go. And that's why we built this platform.
Somebody
Well,
handed me
Justin,
the rankings for Connecticut lending, by the way. And I just want to point out that if you're right, why isn't Rocket Mortgage doing better? They did 30 deals last year and represent a 1.7% market share.
I don't know one real estate agent that wants their clients to use Rocket Mortgage. It's, you know, it's a refi business. It's a refi model. It's drive the consumer to a call center. They market, they spend millions and millions of dollars in marketing to drive the consumer to call in. And nobody buying $1 million home or anywhere that wants to be handheld is going to get that experience, right? You're not going to get local appraisers. You're not going to get local knowledge of mortgage people. It's just not a good model in some, you know, in our market in particular.
Yeah,
and
any
what
lender
Justin said,
can get an app, right? Like Justin said, any lender can get an app now. For a while, it was unique, right? Hey, look, I can get it on my phone. Now everybody, even a mortgage broker, can get an app on their phone that people can apply. There's nothing to see there. In the mortgage business, I'm in it every day. It's very human, right? We're solving problems. You know, there's a computer just capturing data, but there's people, lots of people involved still, right, guys? I mean, lots of people. There's lots of touches, right? I mean, for us, in my world, for sure.
there's always going to be a human element, and there's no vanilla transaction. And what I have found with the millennials, aside from the fact that I'm sure Justin in particular, you could speak on it as well. I've had transaction after transaction where, forget about do they want to meet in person, the only communication is via text. But what I personally have found to be successful is that when you educate this younger consumer, it almost makes them want to show off what they've learned. It almost makes them want to go sit at the dinner table on Sunday and talk about their newfound knowledge in banking and real estate. And I think it allows them to be a client for life. But even more so, you know, you provide the technology and also have the access to give them the human element education that a call center can't give them like we can.
The Rocket Mortgage, that's a national thing.
Yep.
So they get 1% of your market, John, but 1% of every market in the country. That's a lot of money.
It's a big company, no doubt.
Just to give you a perspective.
That's their model, right? It's about volume. Let's just get a little bit all the way across the board.
They did 30 deals according to this last year, and Citibank did 118. So Citibank has a 7% market share, and TD Bank has 1.5, and Rocket has 1.5. It's a very fragmented market. So if you thought that the too big to fail 5 we're doing all the business, it doesn't, not at all. It looks like there's a lot of community banks on here, representing, their slivers.
So I'd like to have a survey of you guys. So the regional banking component of our industry has obviously drastically contracted from 18,000 banks that John had spoken about. What do you guys think happens in the immediate short term next year? And then where do you think it is in 5 years? Will it have contracted?
I'll just quickly say that I think, we've seen the reduction in the absolute number of banks for a number of reasons. These consolidations are how banks grow, number one. Some banks really just kind of folded up. I think the credit unions have gotten really smart as well, and they've been growing and they've been getting into the commercial business. So they've been putting stress on some of, the mainstream institutions. But if I had to answer where are we going, we'll continue to see consolidation in certain markets. I mean, there's a lot of small banks that own their markets. And as there are other banks that are growing and infiltrating, there's pressure on them to combine. So, but I don't think we'll see it at the pace that we've experienced in the past. There isn't a really good answer for any of us. That is the unknown, John, by the way. Who knows? But again, banks need to grow, and some banks grow by acquiring other banks. There's, I'll use Ocean First as an example in New Jersey. They've acquired a lot of banks. They're closing in on 12 billion in assets, largely through acquisition. That's how they get their deposits. That's how they get their loans. And being on a public platform, it's much easier to do that because you've got the ability to raise capital and have a bit more of a nimble approach to acquisition. So it'll be interesting. I'm not a doom and gloom person. I think that there's a lot of opportunity for all of us.
Does a smaller community bank have to get bigger to compete, buy or be bought?
I think a smaller community bank needs to really stick to their core principles. And again, a non-public institution, the pressure on public banks is much different. And you really stick to what you know. And I think there are some banks that have gotten cute because they've either gotten desperate or they've needed to provide growth for other various reasons that are obvious. But I think we'll probably expect lower single digits of growth for institutions because everyone's pulling back and they're like, let's go a little bit slower. Let's analyze our credits in a much different way. And we need to attract, sticky, sound deposits. And, the one variable we haven't talked about yet is, what do regulators do? Because they certainly have an impact on everything that goes around the horn here.
Well, there's certainly going to be increased, capital and liquidity requirements on the wake of this. So
I think there's going to be some heightened attention to deposit concentration, on the heels of SVB for sure. I see that.
I came to DC to talk to those regulators based on this conversation. So we're in good shape.
Go get them.
I hear that.
Anyone else with a final, look at the crystal ball? Justin, you got a crystal ball over there?
I don't. I think that, I'm a believer that there's a lot of financial issues, obviously, in the market. I just think there's more fear in the market.
Unwarranted or legitimate?
I think there's legitimate cause for concern. But I feel comfortable that the industry in the banking industry hasn't gotten that far out of line as it did years back. But I think, and this happens not just with this banking issue, but across the world, in all areas. You can't turn on the TV or listen to the radio or read a newspaper and it doesn't seem to be doom and gloom. And I think there are a lot of people that are sitting on the sidelines, even though we have a strong buyer demand right now. I do think there are a lot of people that are sitting on the sidelines because they're scared. They're scared that, interest rates are going to go way up, or they're scared that, banks are going to get really tight and they can't lend, or they're scared that, the world's going to fall apart. And I think the longer we get through this and the more things calm down, it lines up perfectly with our spring market, knock on wood. But I think we saw it in interest rates. When interest rates spiked, everybody got panicked, and then they realized, okay, not so bad, and now they're getting back in the market. I think the longer we work through this, the continued increase we're going to see in activity.
Yeah, I agree with that. I've already seen the increase because we do all 50 states. So it's no particular market that's changed, but just a general increase in activity, loans coming in, and, compared to where it was, which was extremely low in January, February. And now, I've seen it turn. I definitely think we turned the direction, but and I think stable rates will help a lot, right? If they just kind of stick around where they are, it would not be terrible, right? And just stay the course.
Stable
Don't
rates
do
and a lot of
anything else.
houses to sell.
Houses.
Yeah.
Houses.
And finally, Christopher Tortorello, tell me, national lender, cross-county mortgage, all this fear in the banking industry, you guys are saying what? Put the foot on the gas, right? Time to grab some market share.
Listen, we're optimistic. I think at the end of the day, first of all, as a correspondent lender, the concerns that a lot of these banks deal with the deposits are not on our radar. And stability is key. As the market stabilizes, everyone's confidence grows, and there are buyers out there. The inventory, hopefully that will come.
Well, thank you, gentlemen. This was a great hour. I think I learned a lot about where is community banking's place. I understand a little bit more about the correspondent lenders, the wholesalers, how you feel about risk, how banks are adjusting to risk. I learned a little bit about Las Vegas, poor guys in Las Vegas, and maybe Arizona too. So thank you very much. I'm going to invite you back in 6 months, and we're going to see if you were right. And, on all your predictions, interest rate predictions, going sideways, right?
Short-term memory issues.
Sideways.
And meantime, Roberto and I will try and scare up some more properties for you guys to finance, won't we, Roberto?
Indeed we will. I actually feel with all the bruises that we all have from years and years and years of doing what we do, I think we're all kind of optimistic. So I feel good about that.
Yes,
Definitely.
I'm feeling pretty good about that. We're coming out of this uncertain times. And yeah, people are starting to make decisions again and buy houses and sell houses and move forward. So yeah, I share your optimism. So thank you, everybody. We are off for the next 2 weeks, and then we launched our new season on voiceamerica.com. Details to follow. Thank you. But look for you in 2 weeks, 3 weeks at a new time, Thursdays at 3:00. In the meantime, thanks, everybody.
Thanks,
And,
John.
Thanks, guys. Really appreciate it.
Good luck,
Skipper, we'll
guys.
see you.
Thank you, everyone. Stay well.
Thanks.
Bye.